Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend, Dr. Friday with Dr. Friday's Tax and Financial Services over in Brentwood, Tennessee.
That's me.
We've been working together for a lot of years, working with clients and how to minimize their taxes. And this is one of the areas, typically when you see someone, an accountant or someone that does taxes, of course, one of the things they typically will talk to you about when it comes to reducing your taxes are the kind of things you can do this year, such as putting money into an IRA,
right,
or putting in, more money into your 401k, or if you have a SEP IRA, whichever kind
right,
of plan, your thrift savings plan, whatever it might be. Those are ways that you can reduce your taxes immediately. And these days, we also have Roth IRAs, Roth 401ks, ways that you can put money into a company plan potentially where you don't get the tax benefit today, but you reduce your taxes. It grows tax-free, and when you take
right,
it out, it would be tax-free. So there are a lot of ways that you can do tax planning. One of the areas there, when we look at it, is not though just when Dr. Friday and I, when we work together with clients, one of the things that we do differently is that we're not just looking at this year. We want, of course, that's important.
Instant gratification. That's my job. Okay, instant gratification. He's long term. Long term. He wants to make sure that what happens today can continue for the rest of your life or into the next generation or whatever. But most tax people, we're looking at today. We're looking at what can I do in this period of time, January through December, to keep the taxes as low as possible and to keep as much money in their pocket. And that's not always a good thing.
Yeah, this is where balancing it out, determining, well, we tax deferrals good, and reducing your taxes this year is good as well. However, if it's going to create a bigger tax problem later, we may want to plan to where we can, find a balance of, yes, let's get as much tax benefit today, but let's also make sure we're not creating a bigger problem for tomorrow. Let's in fact look at it longer term. One of the things that comes into play goes again with Roth and Roth conversions, how to plan those. Again, we talked about capital gains taxes, how to plan for those. If you understand that and understanding the difference of just the way the progressive system works, and if you cross over certain, and again, out of the 15% bracket or the 12% under new legislation, that what impact that could have then in terms of other things you do. We look at that all in advance. So when I'm sitting with clients and we're doing tax planning, that's what we're doing. We're looking at, well, what's your income going to be this year? Can we do anything? Is this a good time? And this is a great time of year, by the way. We still have time for those things like selling off and pruning and exactly. So some really good things we can get done before the end of the year to help you reduce your overall taxes, again, not just this year, but maybe even paying a little extra this year so we don't pay next year.
Well, that's why I had to throw in there. Okay, let's assume that something similar to what we're looking at today goes through. Yeah. And obviously, is there anything that somebody should be looking at? I mean, you can't work on tax plans that don't exist. Either can I, right? We have the idea we like to talk about, but until we know it goes into law, we can't make. But I'm assuming if this goes in, you're going to be a very busy person next year, because that would make pretty big alterations on people that were in the 10 and 15. Now that we have a bigger bracket, theoretically it could change some of the plans, right? I mean, these people should be looking, if you have a tax person or a financial planner, next year would be a big year to reevaluate those plans. I know every year you meet them anyways. But
sure, but yeah, based on what we're looking at right now, that gives us an extra $14,000.
That's huge. That
we can work with regard to capital gains and, basically selling off some things and paying zero tax. Maybe doing more on the Roth conversion side. We've got more money to work with now potentially to assist us in again minimizing taxes overall. Right. Creating a Roth is another area there. Understanding how Roth works and the benefit of that tax-free. It's great for also when you get into legacy planning. This is another area. If you're taking tax deferred accounts, let's say you're in the 15% bracket, and you're saying, well, I'm not paying that much in tax. Well, guess what? If you're not going to use that money during your lifetime, all of that IRA, and of course most of us are saying, well, we don't know how long we'll live, so therefore
it's hard to know.
we kind of want to plan that we're going to have that money last for as long as we do, right? Exactly. It's all about maintaining our standard of living and quality of life no matter how long we live. And since we don't know, we need to make sure that we plan as if we're going to live maybe to age 100. Who knows, right? More and more people are living longer. So here it comes back again. Let's say we don't use those retirement accounts and they're going to our children. All right, what is that going to mean for them and their taxes? What bracket are they in if they're starting to take now? Here's one of the things to understand about required minimum distributions as an example. At age 70 and a half, all right, for on yours, you have to start taking money out. So using what's called the Uniform Lifetime Table, and it's based on your age, and it starts at a little less than about 3 3/4%, give or take, and then it progressively goes up over your lifetime, okay, as you're taking that money out. Well, when you pass and there's money going to your children, guess what? That money they now have, it's called a single lifetime table. It's a more aggressive table. They're going to have to take a higher percentage out and require minimum distributions during their lifetime. And it's not something they wait till age 70. At whatever age they're at, they have to start taking it then. And it's added to whatever their income is at that point, probably meaning they're going to be paying a higher tax. What does that mean? It means that the IRS gets more and your family gets less.
Right.
Okay? Better planning would be if you would rather have your children and your grandchildren as your beneficiaries rather than the IRS as your beneficiary. A little planning can go a long way. All right,
yeah,
and you can do it in such a way that you are not going to pay any more tax on those dollars than you would have anyway. Okay, but we're just, I'd say the only loser is the IRS. Who's for that?
Me.
Okay, so one of the things again about tax planning, get in and get this done. All right, if you've got to, this is one of those areas, understanding the importance of tax planning. I talk a lot of time, a lot of people have tax preparers that they work with, and these are, this is important. You need someone who knows how to put the right numbers in the right little boxes to keep you out of the big box with the bars on the window, right?
Yes.
So that's important. But tax planning, that goes throughout the year. We're always looking at ways, and we're looking at your situation to see how we can do that. Now, if you'd like to get that for yourself on a personalized basis, then all you need to do is be one of the first 10 callers to my office this morning. We'll put that up for you again. For the first 10 callers to my office, 615-376-5325. Now, tax planning is a big part of planning, but we talk about other things as well. Healthcare being one of those, Medicare, and how that works, what the out-of-pocket costs are, which one, what's the difference between original Medicare, Medicare Advantage plans, Medicare supplement plans, what does it all mean? You're talking about somewhere around $6,000 or more per year, at least, in expense. These are areas that you really need to understand how these things work and how you can basically help reduce those costs. That's $6,000 just in premium costs, by the way. It's not counting additional out-of-pocket costs, which is why they talk about over retirement. You could spend like $220,000, $250,000.
That's a lot.
Yeah, and Warren Buffett
Medical's
recently
going up all the time.
Yeah, exactly. And the expense for medical keeps going up. And
what did Warren Buffett have to say?
Warren Buffett was in an interview recently was saying, the corporate tax thing, yes, that's the help. But he said, one of the areas they really have to address, and maybe this is why Congress tried to do this initially with the healthcare legislation, healthcare reform. We've got to find a way to reduce healthcare costs, and this goes for large corporations and small businesses. If you're, in my company, for instance, we, provide a healthcare benefit, both for, for the employees and everything. This is an area that's a big, in every year, it goes up
20-25% every
these aren't
single
small
year.
increases. Yes, when you're looking at your healthcare costs, so think of companies that their healthcare costs are going up 10, 15, 20%. Reality, it is 20, 25% or more per year typically. These are huge increases. How are they going to accommodate that? And yes, reducing that down would be another big help to business and would help them as far as bottom line and being able to then expand those businesses and maybe even provide a better benefit, which is the other part of it. As these expenses go up, you're saying, well, man, I have to raise the deductible. I have to reduce the the amount of benefit that they're going to be able to receive because of the expense of it. So understanding how these things work in your own life, and this goes with Medicare as well. When you reach 65 and first qualify for Medicare, it's not like these things go away.
No, there's means testing in Medicare, right?
Yeah,
I mean, so the out-of-pocket costs, some people could pay as little as $900 a year, and some people pay as much as $1,500 a year, based, again, on your taxes. And if you do something on your tax return, sometimes, if it's a one-time transaction or whatever, it could kick you for another year. Some people have had to pay higher Medicare for a year, which when you're on a fixed income and you have an extra $50 coming out could really be painful.
Yeah, I've got a client right now that came in just, it's been about a month or so ago now, but that was one of those situations. When they were working, and they were working past age 65, when they stopped working, the income that they had made in that year basically tagged them on Medicare and caused their Medicare premiums to go up. And the way that works is they'll look at that income, say for 2017 as an example, that goes up, your Medicare premium goes up, and when you do your taxes, say in 2018, all right, so now they see that. So in 2019, your taxes go up. Basically, you're going to be stuck with this increase for possibly a year or two, until the cycles back around to the lower income piece. This progressive system that we have, and again, understanding how that works. It might have been the difference. Someone might have looked at that and said, well, looking at all the different costs, might you make a different decision? understanding what the consequences, if you will, or the implications of your decisions today and how they're going to, what the impact's going to be long term, that's kind of the key to planning.
Absolutely.
So this is one of the areas. So if you're taking money out of a retirement account as an example, and understanding if you took out, let's say, $20,000, the impact of that versus say 30,000.
Right.
30,000. I mean, if all of a sudden you're paying 2,500 on that extra 10 grand versus 1,500, that's 1,000 in savings. Could you have just waited? A
few
like
months
right
sometimes, because I mean that's why I always love this time of the year.
Right.
Because when someone says, well, I need to have $40,000, I want to do a house or whatever, and you're sitting there going, okay, let's take out, because if we do 20 a year, we're in great shape. We keep them in the lower bracket, and then if you do it all in this year, you've just doubled up on taxes. Where, like he said, the second part of the 20 is now at 25% tax bracket, which is crazy.
I mean, that's that jump, and it's going to be the same. And you're going to go from 15 to 25. Well, guess what? Now it's jumping from 12 to 25. So
it's going to be even worse.
More than doubling your tax rate by crossing over that threshold.
Yeah.
So understanding how that works and how you can use it in planning is so important.
I love that game.
So this is one of the things. So again, if you're, I put it up there as far as the first 10 callers.
Right.
Tax planning we get into, healthcare planning we get into, investment planning we're also going to be talking about, because guess what? It's the same thing.
It all feeds together.
How much you make on your money, but if you're paying taxes on that money, more taxes than you have to,
right, that's
less that you get to keep again. So understanding how your investments work within a 401k, and we're going to talk, in fact, I'm going to share a tax strategy. We have to take a break, but when we come back, I'm going to show you how you can, in fact, reduce taxes, and understanding again how capital gains and ordinary income tax rates work can help you in terms of how you structure your investment portfolio to minimize your taxes as well. All right? Quick tip, when we come back, join us here on the Retirement Report.
Are you